Hello, everyone. We're going to finish up the stock market this week and hopefully get our spreadsheets set up for our weekly presentations. And by the weekly presentations, so just once a week, you're going to look up your stock price and put it on your spreadsheet and save it. And let me see what it is as you turn it in as an assignment. And we're going to keep doing that throughout the semester once a week, and then you'll turn it in when you get finished with it. Okay, and hopefully the graphs will look nice and you'll learn something from this. Some of you have already picked your stocks, and that's okay, and that's great actually. And some of you have picked kind of high stocks, which that's it's up to you. I had put the $500 limit on there because I wanted you all to see how much you could make with a smaller investment. A $500 investment in the stock market's not very much. So, we'll learn more about it as we go on. That's what this is all about, is just learning about the stock market. It's not being a master of it. By no means are we going to be a master of the stock market when we finish this. I just want you to learn what it is and what it's about, and how you can use that to your advantage when you go to make investments. Okay, so let's see, if you all want to raise the limit, if you picked a stock that's kind of high and you don't want to stick with that $500 limit, you want to buy 2 or 3 stocks. I don't want you to get extravagant. You're not going to spend thousands of dollars. It's just an exercise here. So if you want to raise it up to where you can buy a couple of stocks at a high price, then you just let me know, and I'll be glad to let you do that. I'm going to keep mine at $500. And so, and if y'all that already stick, I would prefer you stay at $500. But if you don't want to, that's fine. I mean, this is for you to learn. This is for you to learn about the stock market. So whatever you've got to do to make it more interesting for you is fine with me. Okay, and then after this, we finish up. So next week, we're going to spend a week on looking at different types of investments. And all investments kind of go back to point to the stock market. And that's what companies they'll invest your retirement in the stock market, and you can make a lot of money that way, or you can say you want to stay safe. We'll go over all that, so don't worry about that right now. So after that, we'll begin working on our careers. So we're going to do investments next week, and then after that, we're going to spend a couple of weeks on working on careers, and whether that career be a job or college or the military or something like that. Okay, so let's start with the slides here. Okay, and stock market basics. Okay, so what are stocks? That's what we're trying to figure out. And a stock is a share in ownership of a company. So that's all you're doing is when you're investing in stocks, you're participating in the ownership of a company, and the stock represents a claim on the company's assets or earnings. Okay, as an owner, shareholder, you're entitled to the share of the company's rights. Voting rights. Okay, and why do companies issue stocks? Okay, so you're saying if they're going to pay me, how are they going to make money doing this? At some point, every company needs to raise money. All right, so they've got to raise money to invest in the business. You know, Instead of borrowing money and having to owe money, they just sell stocks and have other people invest in their company. So they use that money you invest in their company and try to make their company grow. And so I don't think anybody's intention of starting a company is for it to fail. So everybody that starts a company is wanting it to grow. Okay, what does the shareholder get out of the deal? Okay, the shareholder is you, gets the hope that the shares will be worth more in the future. So say if you buy something at $10 a day, you know, 10 years from now, if it's worth 100 times that, you're going to make some money and you're going to get dividends. So that's what it's all about you investing in this company uh, expanding and growing and making money for the guy that owns it, and with him making money, all his shareholders are going to make money. Okay, and one thing you'll hear about in stocks is an IPO. So what's an IPO? And the IPO is the initial public offering. So when this company decides to start selling stocks and they get everything set up, the first day they go in the market, it's called the initial public offering. So that's what the stocks begin at. So like somebody like Amazon or Netflix or somebody like that's gotten people very, very wealthy, whatever they started out with, if you invested, got 100 shares of stock at $5 a share, and now instead of $5, those shares are worth $1,000 or $2,000. You picked the right stock. Okay, now what's a dividend? A dividend is the money that a company pays to its stockholders from the profits it makes. So if you make a good investment and you invest in a company that's growing and growing, you'll start getting paid by dividends. Okay. And what is the difference between common and preferred stocks? Okay, so there's a big difference in the stocks. There's a lot of different stocks, and it's kind of confusing to you. So just kind of stick with the simple stuff here. So the common stock is the type most people purchase, so hence the name common. It represents ownership of a company and a claim on part of the profits. Investors get one vote per stock. Okay, preferred stocks don't have the same voting rights, but investors are usually guaranteed a fixed dividend. Okay, so preferred stocks is the stocks that are going to be a little bit more expensive, and you pretty much know if you invest in a preferred stock, it's going to make money, but it's not going to make as much money as a stock that you take more of a risk. So it's just like gambling. The more risk you take, the more opportunity you have to make money, and the more opportunity you have to lose money. How do stocks trade? Okay, so that's what we're trying to learn here. Most stocks are traded on exchanges such as the New York Stock Exchange or the NASDAQ. The New York Stock Exchange is a physical location, whereas the NASDAQ is a virtual market. And the New York Stock Exchange is the oldest one in America. I think it started around 1762 or 1782, something like that. It's in New York, and it's been there. I guess that's how they got the name Wall Street, because that's where it started. Exchanges are simply places where buyers and sellers meet and decide on a price for the stock. Okay. The New York Stock Exchange, orders come in through the brokerage firms and flow down to the floor brokers, who go to a specific spot on the floor where the stock trades. Okay, so you've probably seen that on TV where the guys are standing there screaming and the bells are ringing and they're looking at a big board hanging up there and they're trying to sell these stocks. It's pretty fast-paced, action-packed event going on there. So it's like a constant auction is what it looks like, and from what I've understand about the stock market, it's like they're constantly auctioning stuff. The NASDAQ exchange. NASDAQ is a virtual market, over-the-counter market. It has no central location or floor brokers. Trading is done through a computer and telecommunications network of dealers. Okay, so it's talking about here continuous bids and prices with prescribed percentage spread. And you can trade stocks either way you want to on the New York Stock Exchange or the NASDAQ. In the United States, is the United States the only country with stock exchanges? No, it's not. And the two main hubs, like it says here on the slide, is the London Stock Exchange and the Hong Kong Stock Exchange. What sets the price on a stock exchange? Market forces changes stock prices every day. So share prices change because of supply and demand. Just like anything else, supply and demand. As this stock comes in more demand and people start wanting to buy it more, then the prices go up. So okay, so if more people want to sell than buy, the price goes down, and then you start losing money. So that's what you're watching. That's why you're constantly watching. If it's going up, you're making money. If it's going down, you're losing money. Okay, what makes people want to buy one stock over another? The price of a stock indicates what investors feel a company is worth. So that's, you've got a lot of these richer people that watch this all the time, and they make a lot of money on the stock exchange. So when they invest thousands of dollars in a company, that makes the prices go up. And if they decide, oh, this company's kind of stagnant right now, I'm going to move my money somewhere else, and they've got a few thousand shares and they just drop them all in one day, that's going to make that stock go down. So that can really hurt you. So that's why you've always got to keep up with what's going on if you're an investor. Okay, and what else might influence the price of a stock? Oftentimes current world events have an impact on the stock prices. So that's why you've got to if you do invest in stocks, you've got to keep an eye on the world affairs, because just like with the what they're talking about here, 9/11 and some other things that's happening recently, this coronavirus thing. One thing, like, I don't know if y'all have heard of Warren Buffett. He's one of the very rich guys, and he had a huge investment in Delta Airlines, and then as soon as this coronavirus thing hit, he sold all of his shares of Delta, so that caused all the airline stocks to go way down. So that's why I decided to invest in JetBlue, because it's a smaller airline and I could get stocks cheaper, and because they all dropped, it made it affordable. And I think, everybody likes to fly, everybody likes to travel, so I think that'll go back up. What's about all these okay, yeah, right here, because you hear about the bull market and the bear market and stuff like that. So the bull market is when the economy is doing well and the gross domestic product is growing and stock prices are rising. The bull market charges ahead. The bear market is when the economy is bad. So if you hear the bear market coming up, it means the prices are dropping. Okay, so that's the two animals we're talking about. The bull market is charging, going up, and the bear market, the economy is bad, recession is looming, and stock prices are falling. Okay, what about all these animals? Okay, the chickens are afraid to lose anything. They invest in safe things like bonds or mutual funds. The pigs are high-risk investors. They want to make a killing in a short time. Unfortunately, they're usually led to the slaughter. So there you go. That explains, if you want to be safe, you bet like a chicken. If you want to take a high risk, you bet like a pig. But unfortunately, you might lose a lot of money that way. Okay, so reviewing all this, stock means ownership. You can lose all your investments with stocks. The two main types of stocks are common and preferred. Stock markets are places where buyers and sellers come together. Stock prices change according to supply and demand. And bulls make money, bears make money, chickens make money, but pigs get slaughtered. All right, hope you enjoyed the slideshow.